Hey, how's it going, everyone? My name is Jesse, and today I'm going to be checking out global payments, GPN. Here we got the 5-year chart. We can see over the last 5 years, we're closing in on 5-year lows right now. It's pretty close to 5-year lows. 10-year, we can see that they've had massive price appreciation over the last 10 years. A couple dips here and there, and then we are in a fairly strong dip/downtrend right now. So, which presents for an interesting opportunity if I end up liking the company. So, with that being said, let's go ahead and dive on into the investor presentation. All right, so here we have the Q3 2022 earnings presentation. And I just want to go over a couple things here. So we can see total revenues 2.06 billion, just EPS 2.48, about 1.45 billion of their revenue comes from their merchant solutions. As being like a payment gateway, a lot of their revenue currently is coming from the merchant solution side. Just operating margins 50%, up 60 basis points. Outlook, low double-digit growth, up to 170 basis points increase on the operating margins. So we look at the issuer solutions, and we've got about 489 million in revenue, and pretty much, better basis point growth on the operating margin side. Kind of the same on the Outlook side. And then we have the constant currency outlook, adjusted net revenue up 10 to 11%, but adjusted EPS up 17 to 20%. So some decent brief information about kind of their revenue breakdown across these different segments right here. All right, so real quick, I just want to go over the fact that they have been doing a bit of acquisitions over the last 10 years. So when we look at their revenue growth, their margin growth, we kind of have to take into account the dilution and the debt that has come in from those acquisitions as they've been growing. How much of the growth is due to just acquisitions? Are they growing just because of acquisitions, or are they getting increased efficiencies and like a better platform due to the acquisitions, therefore growing, but also like expanding margins and able to build out their tech base and grow even more, offer better services? So definitely check out the acquisitions if you're looking into GPN, just to see if you agree with the acquisitions that they've done in the past, if you think they've been accretive and good to the company overall on top line and bottom line basis, if it's helped build out the service offerings of the company, maybe given it a better moat, something to consider, especially when we're looking at the qualitative side of the business. So definitely check that out. All right, let's go ahead and jump into the financials, and we're going to see over on the income statements, we can kind of see just the growth that they have had. And as we talked about previously, they have had a lot of acquisitions in the past. So we can see kind of these jumps in revenue as they've done acquisitions. We have to be very, aware that some of this growth is coming from acquisitions. If we look at the average shares outstanding diluted, we can kind of see these bumps in shares or the bump in debt when these acquisitions have gone through. But all things considered, the increase in shares seems to be relatively decent compared to the type of revenue net income increases that they've seen from the acquisitions they've had. We do see a huge, massive drop in EPS right here in, let's see, was that Q1 2022, a couple quarters ago? If we want to, let's go over to that quarter and we'll see what happened there. So if we go over to that quarter and we go into the, let's see, income statement, there we see. So we can see that there was a large impairment of goodwill and a loss on business dispositions. On a year-over-year basis, that made up for, let's see what, almost closing in on $1 billion. If we wanted to take the impairment of goodwill out of the basically income statement, along with the loss on business dispositions, we could see, let's do that real quick. So we got 833, right, or so, plus 152. So, and then we're going to minus 529, and we would have had a operating income of about 456 million, if my math is correct, instead of a operating loss of 529. So it's it's one of those things where it looks really bad. If you're just looking at the EPS or the graph, it looks like what the heck happened there. But it was just an accounting for a decrease in taking a goodwill hit. Because eventually, I mean, you can only take so much in goodwill decreases. Eventually, you would run out of goodwill. So their cash flows are still decent over that period, even though they took that huge impairment. Go to the balance sheet. You can see that their cash balance has been relatively stable. Even going through the acquisitions, they've had a fairly stable cash balance. It's not like they're burning through cash. Here we can see the goodwill and intangible assets. And here is where we see, like, they got a lot of goodwill. Dang, they got a lot of goodwill. So maybe we do see just massive hits in goodwill. And it looks like their EPS is really, really bad from that, because they're accounting for all of this goodwill. What is that? 23 billion, 23.5 billion currently in goodwill, and another 9.9 billion in intangible assets. Pretty crazy. So their total assets are around 44 billion, total liabilities about 21 billion. Long-term debt's about 12.2. Current liabilities is about 6. Around 6 billion in current liabilities, 5.6 billion in current liabilities, while they have about 2 billion in cash and short-term investments. So if we go to the free cash flow statement, you can kind of see the operating cash flows over this period of time, and then we can also see the free cash flows over this period of time. Yeah, it's interesting. They have been doing a ton of debt repayments, as well as some common stock repurchase. So it's an interesting one. I think if we go over to standard template, what's their, so it says their enterprise value is pretty close to their market cap currently. All right, so initially it looked like the enterprise value was close to the market cap, but just something looked off. So if we go over to the ratios and metrics, I think I was not calculating the LTM correctly. Because here we can see as of September, end of September, the enterprise value is actually about 41.6 billion, while the market cap is about 29.7 billion. So we have a decent amount of, I'm guessing it's going to be long-term debt. So yeah, we have a decent amount of long-term liabilities, decent amount of debt that is taking that enterprise value and making it quite a bit higher. So that's something to really keep an eye of when you're valuing a company, is you want to value it based off of potentially enterprise value instead of market capitalization. Because if your market cap is really low, but the company has a ton of liabilities, so say your market cap is like 10 billion, but you have 10 billion in liabilities. Well, if you're doing your valuation based off market cap, and you're not accounting for the risk that the company's holding with their debt, then it might not be an accurate reflection of what the company could truly be valued at. In my case, I like to, if there is a decent amount of debt that I think should be counted, I'll go off of enterprise value instead of market cap. In this case, I'm kind of on the fence. I don't know. I'm just kind of thinking out loud here. Like, would I want to go off of market capitalization, or would I want to go off of enterprise value? I don't know. We'll go off of market cap for now. I might reevaluate eventually too. Growth, we can see different revenue and gross growth numbers here. They've had fairly decent growth. EPS growth, dilution, buyback. They've been a diluter as they've been doing these acquisitions, and now they're starting to buy back. Dividend growth, they recently started offering a dividend, so they're returning capital to shareholders mostly in the form of a small dividend, very small dividend, but also common stock repurchased, so buybacks. And we can see in the standard template, actually, let's go to income statement. Yeah, we can see the buybacks kind of ramped up right here, and they've been slowly buying back shares. So we are seeing capital return to shareholders in that way. So as the float gets lower, the evaluation kind of EPS will rise. Evaluation will get skewed towards the stock going up. So if we go to the standard template, so currently we see dilution over the last 5 years has been about 13.47%. And that's from those acquisitions. Bottom line growth about 28.14%. EBIT yield spread pretty much zero. Free cash flow yield spread 1.7. Now, when doing this evaluation, it's kind of hard. Like, do you want to plan for dilution? Like they're going to do additional acquisitions, and you would then try to maintain your bottom line growth? Or do you say, you know what, maybe the acquisitions are over. They're not going to be acquiring as heavily because they've already acquired everything that they need to. And we just bumped down our bottom line growth numbers a little bit. I decided to go into the camp of I think they're going to be doing buybacks, less acquisitions, and then I reduced the bottom line growth. Now we can see on the buybacks over the last 12 months, they've done they've bought back about 5.84% of shares, assuming these numbers are correct, shares outstanding. So they have been doing a decent amount of buybacks. So in my bullish case, that's what I basically put, very bullish, 5.53% buybacks, to very bearish, 2.5% buybacks. This could be wildly off because if they do an acquisition, we could see massive dilution. But if it's accretive to the business overall, we should see a fairly like similar reflection in the top line growth and the bottom line growth, right? So maybe they dilute at 5% or 7%, but instead of seeing bottom line growth at, you know, the best case 20%, we see bottom line growth at the best case of 30%, right? So as long as they're being wise with their acquisitions, it's probably going to wash out. And that's why I kind of said, you know, if you're looking at this, definitely go and see the previous acquisitions if you agreed with them, if you think they're making smart acquisitions, because up until now, a lot of their kind of build out and what they've kind of like built the company around has been acquiring companies at like good values that are going to be accretive to their business long term. All right, so we got the risk-free rate from the very bearish to very bullish is 4.87, very bearish to 1.99, very bullish. And I think we're in like 4.3s or 4.4s right now. So we're already kind of in my very bearish scenario for the risk-free rate. Dilution, very bearish, 2.5% to 5.53%. Bottom line growth. Now there, at least for 2022, they were, I believe, projecting top line growth in the high single digits to low double digits, and bottom line growth was, or EPS growth around 17 to 20%. So I have a very bullish scenario of 20% with a very bearish scenario of 10.5%. These scenarios, we have the EBIT yield and net yield spreads going from 0.26 to 0.06, 0.39 to 0.09. The free cash flow yield spread is a bit larger, 3% to 1.7% for the fair value off of the risk-free rate. So, and this is going to be a pretty huge spread. Yield spread, or bottom line fair value yield then from the very bearish standpoint would be 6.08. Very bullish would be 2.61, and that would be a very, very high multiple. Probably realistically, I'm thinking somewhere in the bearish to base case is most likely. So if we look at all of these, and I did make an adjustment because we had that 1 quarter of goodwill impairment that really messed up these last 12-month numbers. For all my evaluations, I did an adjustment over here that basically just adjusted the cash flows to start off of, the EBIT, the net yield, or the EBIT, the net income, and the free cash flow to go off of the 2021 ending numbers instead of the last 12 months numbers, because the LTM numbers are so skewed from that goodwill impairment. Although, like I said, we could see continued goodwill impairment, that makes it look like EPS is really bad, but their cash flows are still pretty good, pretty decent. So after making that adjustment, targeting a rate of a base CAGR of 15%, margin of safety of 2.5%, a dividend yield of 1%. Target rate is going to be about 17.5% plus a 1% dividend yield. And that gets us into about like a $95 buy price for the bear scenario, 134 buy price for the base case, 193 for the bullish case, 286 for the very bullish, and a $68 buy price for the very bearish. But like I said, if I decided to do this evaluation based off enterprise value instead of market cap, that could skew these numbers a lot. So, and in that case, the buy points would actually go down pretty significantly. But right now I'm leaning towards this being the evaluation that I'm more confident in. I think there is a pretty decent amount of value for GPN at the current price. So yeah, that's what I got for you guys. Hope you enjoy it. It's been a while. I'll try to keep doing these more frequently. Just document my thoughts. It helps me. Kind of talking out loud can make me realize like, oh, maybe I didn't think of this correctly, or I can kind of learn from myself and from you guys. So hope you have a great day. Have a great week. Happy Monday, and we'll catch you later.